Assalamu alaikum class. Today is lecture number 17 and chapter number 9, that is profit planning. In this chapter we will discuss about budget, its types, and planning and controlling the budget, advantages of budget, responsibility, accounting, budget period, and different types of budgets. So first we will start with what is budget. We can define budget as a quantitative plan for acquiring and using resources over a specific period of time. Budget involves acquiring and using resources over a specified time period. What will be the purposes of budget? There are two purposes. First one is planning and second one is controlling. As you already know, first purpose is planning. That involves developing goals, and preparing various budgets to achieve goals. Another purpose that is called control. It involves steps taken by management to increase the likelihood that all parts of organization are working together to achieve the goals set in planning stage. It means these two purposes are interconnected to each other. In planning, we will set the goals and prepare various budgets, and by controlling, we will use steps to increase the likelihood that all parts of organization are working together to achieve those set goals that we done in planning stage. Then comes the advantages of budget. We can describe that budget communicate management's plan throughout the organization. This will be our first advantage, that we already plan for what purpose the planning is done, to achieve goals. Budget force managers to think about and plan for future. It also involves planning and thinking. So the third benefit, or we can say advantage, is that budgeting process provides a mean of allocating resources that we have already uh, defined in budget definition, that budget process provide a mean of allocating resources to those parts of the organization where they can be used more effectively. These resources can be used more effectively. Fourth advantage is that budgeting process can uncover potential bottlenecks before they occur. So budgeting process, what is the advantage? That it will uncover the bottlenecks before they occur. We can face shortage. We can see how much resource, how much budget, I mean financial resources are available. We have to manage them, we have to arrange them if there it create shortage. So this is the feature that budget will uncover. Our fifth advantage of budgeting is that budget coordinate the activities of entire organization by integrating the plans of its various parts. It means budget help us to ensure that everyone in the organization is pulling in the same direction. The last but not least advantage of budget is budget define goals and objectives that can serve as benchmark for evaluating subsequent performances. It means goals will be defined and objectives will be our benchmark. In easy word, this benefit, yeah, this advantage is for the controlling. Then comes the concept of responsibility accounting. Responsibility accounting can be defined as that a manager should be held responsible for those items that the manager can actually control. Those items that manager can actually control to a subsequent extent. It means it cannot fully control, but up to some extent. To explain this, we can get an example of revenue and cost. Revenue and cost, these are used in the budget as the responsibility of a manager who is responsible for deviations between goals and actual results. So, how the responsibility accounting relates to a manager, that he can control revenue and cost and take the responsibility in budget for deviations between goals and actual results. Like we can say, if we have to enhance our sales, we will decline our cost, or we can decline margin in the profit, so our sales will increase. In the same way, if our sales are increased but cost is not up to the mark or not matching our goals, so what we will do, we will increase the profit margin. With it, our cost will be covered and our revenues will also increase. So the discount promotions are for the sales increase, and sales decline will also result in cost consumption and revenue generation. It is wholly the responsibility of manager. Then comes the concept of choosing budget period. There are two types of budget: with respect to time. The first one is continuous, and second one is perpetual or perpetual. Continuous or perpetual, and second one is periodic budget. In this chapter, we will deal with 1 year budget, process. It is our periodic budget. But what happened in the continuous or perpetual budget? It will be a monthly, quarterly budget, and management need continuous focus and short term results are observed. As compared to it, in 1 year budget process, there is long time span of 12 months, and management get ease on results. Then comes the concept of self-imposed budget. The self-imposed budget is prepared with full cooperation and participation of managers at all levels. It means the self-imposed budget is prepared with the cooperation of top level, middle level, and lower level managers. They combinedly participate and fully cooperate in the preparation of self-imposed budget. There are some advantages of self-imposed budget. The first advantage is that individuals at all level of the organization are recognized as the member of team. So it means everyone is responsible for making budget. The second benefit is that budget estimates prepared by frontline managers are often more accurate and reliable than estimates prepared by top managers, because first level managers are directly interlinked with the needs of the organization, with the material, with the resources. The third benefit is that motivation is generally higher with individuals participate in setting their own goals than when the goals are imposed from above. It means they get self motivated to set their goals because they know what are their goals and how to achieve them. The fourth advantage of self imposed budget is a manager who is not able to meet a budget that has been imposed from above can always say that the budget was unrealistic and impossible to meet. It means if there is only one person, he will say that it's unrealistic and impossible to meet. But when all level of managers will combinely to make budget, all will be responsible. There will be no lame excuse. Then comes human factors in budgeting. It is important to mention that if we need to be if we need a budget program to be successful, it must have the complete acceptance and support of the person who occupy key management positions. If the low or middle level management sense that top management is lukewarm about budgeting, or if they sense that top management simply tolerates budgeting as a necessary evil, then their own attitudes will reflect a similar lack of enthusiasm. In easy words, they will not be self motivated, they will not be a motivated person because they will see there is need that the humans involved or the persons involved in the budgeting are need to be accepted. They accept the budget. In very easy words, if you will be given less resources and they said we need a best output or best results, it will be difficult to achieve. So human factor is also important in budgeting, that the resources that are allocated and given to the persons, they must accept them. They totally accept wholly by heart, or we can say they can be motivated. If they will not be motivated, it will be difficult to achieve goals. Then comes the concept of master budget. Master budget consists of number of separate budget, separate, dependent, and independent budgets that normally lay out the company sales, production, and financial goals. Master budget cumulates cash budget, budgeted income statement, and budgeted balance sheet. Then comes the steps for preparing master budget. The first step to prepare master budget is sales budget. It is prepared by multiplying unit sales with the selling price if you remember in our preparation of income statement the first head is sales, so for sale budgets we will multiply units sold multiply by selling price. The second step to prepare master budget is preparation of production budget. For the preparation of production budget, we will use budgeted unit sales. Then comes the concept of production budget. We can call it a CGS. In production budget, we use budgeted unit sales and we will add desired ending inventory. With it, we will get total needs. After deducting the beginning inventory from the total needs, we will get the required production. In easy words, it is our CGS, the part of income statement. In this, inventory purchases are also the part that will be the third step for making master budget. What we will do, we will start with budgeted sales. We will add desired ending inventory. We will get total needs. We will less the beginning inventory. So we will get our required purchases. To simplify, what is the difference between production budget and inventory purchases budget? The difference is that in inventory purchases we will purchase or use merchandise inventory that we cannot produce, but in production budget we will produce the inventory or we will produce the merchandise inventory. If the company is manufacturing company, it will use production budget. If the company is not a manufacturing company, it's only deal with the merchandise inventory, then they will make budget of inventory purchases. For production budget, the question arises that in production we need direct material budget. I'm repeating again that for the production budget we will need direct material budget. As compared to it, for inventory purchases, we are just purchasing merchandise inventory. We don't need any type of production. So direct material budget, how we will make a direct material budget? We will start with raw material needed to meet production. We will add desired ending inventory. Total raw material needs will be calculated. We will less the beginning inventory of raw material. So we will get raw materials to be purchased. In these type of purchases, we get merchandise inventory. But for this type of raw material purchased or purchases, we get the material, direct material for production. This is the main difference between inventory purchases and production budget. As we are discussing about direct material budget, so there comes a direct labor budget as well. In direct labor budget, we need production units. We will multiply them with direct labor per unit, and we will multiply these two heads with direct labor cost per hour. So in easy words, the direct labor cost is for per hour, but for how many units the direct labor per unit is required, that will be calculated. It will be given that how many direct labor will be required for per unit, and production units will also be given. With that, you will multiply this with the direct labor cost per hour. So you will get total direct labor cost.